The first thing we do when we start modeling a company's financials is to work on the sales forecast. It is important to predict the expected level of sales, as these values will serve as a base for many other items we will have to forecast. Therefore, it is crucial to spend enough time to get the revenues forecast right. Two main strategies can be used when trying to forecast revenues. We can either form a general idea without going into the specifics, top-down approach, or start from the bottom and consider all small details contributing to the total revenues figure, bottom-up approach. When forecasting a company's sales, we might start from the top, consider the total size of the market, and then multiply this number by a hypothetical market share that the company will have and obtain revenues or volumes that will be sold. This is the top-down approach. An alternative method would be to start at a product level and build a forecast, considering the amounts that clients are expected to order of each product. Usually, that's done when a firm builds its budget for next year. This includes a greater level of detail. A company can have dozens of products and hundreds of clients. Sales managers and marketers must work with the budgeting team to provide all the small details that will add up to a total figure. This is how the bottom-up technique functions. We can't reasonably expect we can build a bottom-up forecast for a period longer than 18 months. We simply can't work with this level of granularity as the number of unknowns grows exponentially the further we move from the present moment. Okay, so we can agree that we will have to use the more general approach to forecast revenues. Usually, listed companies are followed by several analysts who have a good industry understanding and publish their forecasts. In addition, there are several analysts and consulting firms who publish industry reports. These professionals closely follow macro developments and industry-specific trends, and their opinions are a great stepping stone for forecasting future financials. In addition, modelers should always look at the firm's past performance. If it grew by 1 or 2% in the last 5 years, are you going to be comfortable to plan a growth of 6 or 7% in the forecast period? Probably not, right? Historical performance is a critical factor that must be considered. Great. So, the forecast of revenues in a 5 or 10-year financial model should be based on a top-down approach, and it should be a blend between industry and macro insights and analysis of historical performance. If the growth you are forecasting deviates from past performance, your model becomes less defensible. Good. Once we've forecasted revenue growth, we can start working with cost line items. Every firm sustains costs to produce its products and sell them to customers. The costs directly attributable to the production process are called cost of goods sold, and the rest of the expenses can be grouped in operating expenses. Cost of goods sold are typically related to prices of raw materials, wages of production personnel, production and logistic efficiency, and so on. However, we agreed we can't apply a bottom-up approach for a 5 or 10-year model. That's why practitioners model cost of goods sold as a percentage of revenues. It makes sense, right? We can first see the percentage of revenues that cost of goods sold represented historically, and then decide what percentage of revenues to apply going forward. The same argument is valid for operating expenses. It makes sense to model them as a percentage of revenues. If a business grows faster, more will be spent for administration, travel expenses, selling, promotional efforts, management, and so on. This logic aligns business development and the costs sustained by the firm. Okay? Great. After we've considered COGS and OPEX, we arrive at EBITDA, earnings before interest, taxes, depreciation, and amortization. D&A is related to the amount of fixed assets being used up and expensed in a financial period. Therefore, it will be closely linked to the amount of existing and new assets on a firm's balance sheet, right? We have to build a separate schedule that will allow us to calculate the amount of D&A in each year. Analogically, interest expenses depend on the amount of financial liabilities a firm has and on the schedule of repayment agreed with lenders. A separate schedule must be built for this item too. And finally, we have taxes. At this point, we've arrived at the firm's EBT, earnings before taxes. Hence, we can use a statutory tax rate and multiply it by EBT to obtain taxes. This is how we can forecast a firm's P&L items. Stay tuned. In our next video, we'll talk about forecasting balance sheet items. Thanks for watching.